Hi, this is Wes Barclay, and this is another episode of Ask the Underwriter.
If you got a mortgage question, call Wes. Innovative and creative, he's the best. 7 years an underwriter, he's the one you want beside you, so don't stress, just call Wes.
Okay, so today we're going to talk about the federal funds rates, inflation, and mortgage rates. Mortgage rates follow inflation, and inflation is simply too many dollars chasing too few goods. We've had a massive influx of money injected into our economy, and then we've also had some supply chain issues, and this has created a rich environment for inflation to get out of control. That sends rates through the roof. The solution is slowing down the economy, and the Federal Reserve has hiked its benchmark Fed funds rate 6 times this year in an attempt to do that. Here you can see as inflation increases, the Fed increases their rate to cool off and slow the economy. The most recent attempt by the Fed to do this came in the way of a 3/4 hike, taking the Fed fund rate from 3.25% to now 4%. Remember, the Fed fund rate is the overnight borrowing rate for banks, and it does not directly affect mortgage rates. So what do the Fed hikes mean for mortgage rates? Well, raising the cost of borrowing on certain items slows the economy down and incentivizes savings rates, driving down demand and thus curbing inflation. So if the Fed is successful at curbing inflation, mortgage rates will decline. Here you can see the history of inflationary times and how the Fed responded. So Burns and Volcker, they had inflation from 7% to 14%, and you see that mortgage rates started to rise. Well, the Fed's response to that was to increase the Fed fund rate 9%, taking it from 11 to 20. And how does an inflation respond? Well, it started decreasing by 9%, and mortgage rates followed. So Alan Greenspan, you'll kind of see that same trend follow. So inflation increased, mortgage rates increased, the Fed fund rate increased intentionally to slow the economy, which slowed inflation, and then mortgage rates followed. So here's where we're at now, 8.5% inflation. We had mortgage interest rates went from 2.5% to 5 and 6 and 7 and even higher. The Fed fund rate went from 0 to 3%, and now I believe we're sitting at 4.25%. So what you should see is inflation drop. Mortgage rates should follow suit. History proves this during rate hike cycle for the past 50 years. Now, here's the good news. The CPI, or the Consumer Price Index inflation numbers, came out on Thursday of last week and gave everyone hope that inflation has peaked. This week's rates have dropped sharply, making this an excellent time to lock in your interest rates. If you've been sitting on the fence, now is a good time to buy. Reach out to me today and I can help you find the best option in these crazy times. Thank you so much. This has been another episode of Ask the Underwriter.
Don't stress, just call Wes.